Hi everybody, and welcome back to video number 6 in chapter 18. And when we left off, we were going to look at explaining the accounting for loss carryforwards, a very important section of this chapter. Okay, so we have a net operating loss, and that's equal to a tax-deductible expense that exceeds taxable revenues. So bullet point 1, taxpayers use losses of one year to offset the profits of other years. Bullet point 2, the company pays no income taxes for a year in which it incurs a net operating loss. And bullet point 3, the company can reduce future taxes payable. All right, a loss carryforward. A company may carry the net loss carryforward indefinitely to offset future taxable income and report and reduce taxes payable in future years. Here they demonstrate 2025 had a loss, and we can carry forward that loss and offset profits into the future. Okay, recognition requirement. Because the companies use carryforwards to offset future taxable income, the tax effect of a loss carryforward represents future tax savings. The key accounting issue is whether there should be different requirements for recognition of a deferred tax asset for alpha, deductible temporary differences, and bravo, operating loss carryforwards. The FASB's position is that in substance, these items are the same. Both are tax-deductible amounts in future years. All right, let's take a look at an illustration. Here, a net operating loss with no valuation allowance. The Grow Incorporated has no temporary or permanent differences between its financial and taxable income. Grow experiences a net operating loss of $200,000 in 2025 and takes advantage of the carryforward provision. The enacted future tax rate is 20%. So, two questions. Alpha, what is the future deferred tax effect of Grow's net operating loss? And bravo, what journal entry would you make to record the deferred tax effect in 2025? So for alpha, the solution is, in 2025, the tax effect of the $200,000 loss carryforward is a deferred tax asset of $40,000. Representing 20% of $200,000. So to record that benefit in 2025 as a carryforward, we're going to debit deferred tax asset for $40,000 and credit income tax expense loss carryforward of $40,000. Notice there is no income taxes payable account in the journal entry because Grow does not owe any amounts to the IRS in the year of an NOL, net operating loss. Okay. Now, this is the recognition of the benefit of the loss carryforward in the loss year. Okay. In the previous example, as illustrated, the account credited income tax expense, loss carryforward, is a contra income tax expense item, which Grow presents on the 2025 income statement. So in 2025, we would have operating loss before income tax of $200,000, and then we would have an income tax benefit of $40,000. So our net loss would be $160,000. Okay. So if there's no valuation allowance for 2026, here is an illustration. Referring back to the GROW information, we're going to assume that in 2026, GROW returns to profitable operations and has taxable income of $250,000 prior to the adjustment for the NOL carryforward, subject to a 20% tax rate. GROW then realizes the benefits of the carryforward for tax purposes in 2026, which it recognized for accounting purposes in 2025. So the questions: Alpha, what is GROW's income tax payable in 2026? And Bravo, what journal entry would you make to record GROW's 2026 income taxes? So our income taxes prior to the loss carryforward with $250,000 given in the problem. Our loss carryforward was $200,000. So our taxable income for 2026 would be $50,000. Our tax rate of 20%, and that finally results in income taxes payable for 2026 of $10,000. Okay, for the journal entry then, the income tax expense would be $50,000. Deferred tax asset would be a credit of $40,000, and income taxes payable would be a credit of $10,000. The benefits of the NOL carryforward recognized in 2026 reduce the deferred tax asset account to zero. Okay, so how would we present the benefit of the loss carryforward realized in 2026 but recognized in 2025? Here's an illustration. The income statement does not report the tax effects of the loss carryforward because GROW reported both previously. The current income tax expense of $10,000 represents what GROW must pay to the IRS in 2026. So if we look in 2026 at a partial income statement, here we have our $250,000 income before income taxes. We would have income tax expense current for $10,000, but deferred of $40,000. So that represents $50,000 income tax, 20% of $250,000. So our net income then would be $200,000. All right, now here let's look at an NOL with a valuation allowance for 2025. So we're going to refer back to the same example for GROW, and we're going to recall that GROW has no temporary or permanent differences. So GROW experiences a net operating loss of $200,000 in 2025 and takes advantage of the carryforward provision. The enacted future tax rate remains at 20%. So let's assume that it is more likely than not that GROW will not realize any of the NOL carryforward in future years. So what journal entries would you make to record the deferred tax effects of GROW's 2025 net operating loss? Well, as before, GROW records a deferred tax asset of $40,000, representing $200,000 times 20%, for the potential benefits related to the loss and an allowance to reduce the deferred tax asset by the same amount. GROW makes the following journal entries in 2025. To recognize the benefit of the loss carryforward, it'll debit deferred tax asset for $40,000 and credit income tax expense loss carryforward for $40,000. Then to record the allowance amount, they'll debit income tax expense for the allowance And then we would have an allowance to reduce deferred tax asset to expected realizable value. The second entry indicates that because it is more likely than not that GROW will not realize the benefit of the deferred tax asset, GROW needs a valuation allowance. So, to illustrate that, we're going to show GROW's 2025 income statement here, a partial income statement. Their operating loss before income tax, $200,000, but the income tax expense deferred is 0. So if we have an allowance, we'll minus the carry forward, it zeroes out here. A little tricky there, but the net loss will still be $200,000. Okay, so now we'll take a look at 2026. We're going to refer back to the GROW information, and in 2026, GROW has taxable income of $250,000 before considering the carry forward, of course, subject to the tax rate of 20%. And as a result, GROW realizes the deferred tax asset and no longer needs the allowance. So what journal entries would you make to record GROW's 2026 income taxes? Well, the solution to record current and deferred income taxes is going to be the same entry as we had before. We'll debit income tax expense for $50,000 and credit the deferred tax asset for $40,000 and credit income taxes payable for $10,000. But then to eliminate the allowance and recognize the loss carry forward, we're going to debit the allowance, which we previously had a credit entry here, as you remember, and we'll zero that out and create an income tax expense allowance, a credit of $40,000. Okay, now continuing with the GROW's example, the company's going to report $40,000 benefit related to the loss carry forward on the 2026 income statement. The company did not recognize it in 2025 because it was more likely than not that it would not be realized. Assuming that GROW derives the income for 2026 from continuing operations, it prepares the following income statement. And here it is. We have our $250,000 income before income tax, but our income tax expense current is going to be $10,000, but deferred will be 0, leaving us with $10,000 of income tax expense and a net income of $240,000. Okay, so possible sources of taxable income. Taxable income, alpha, future reversals of existing taxable temporary differences. Bravo, future taxable income exclusive of reversing temporary differences and carry forwards. Charlie, tax planning strategy that would, if necessary, be implemented to 1. Accelerate taxable amounts to utilize expiring carry forwards. 2. Change the character of taxable or deductible amounts from ordinary income to loss to capital gain or loss. And then finally, 3. Switch from tax exempt to taxable investments. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at evidence to consider in evaluating the need for a valuation allowance. Until that time, bye for now.